Hello students, in the present video I will explain you the concept and how to solve the problems of accounting rate of return or average rate of return. I have already made the videos related to capital budgeting, payback period method, NPV method, ARR method and profitability index. I will share the link of those videos in the I button as well as in the description box. Please do watch those videos even to understand better the concept of capital budgeting as well as the various techniques of investment proposals. So we will start understanding this concept. Accounting rate of return or average rate of return, both the names we will use, don't get confused, both are same. What we will do in this method, we will take the average profit after depreciation and taxation and that amount will be divided by the investment that we made. When we calculate with the help of this formula, that is average annual profit after tax divided by investment into 100, we will get what? The percentage of rate of return the project is earning. That we can calculate with the help of this. So this is the one of the most important methods of capital budgeting techniques. How to calculate ARR, that is average rate of return. The formula for calculation of ARR is average profit after tax divided by original investment into 100. Simple formula, we can apply this formula and we can get the answer. So how to calculate average profit or profit after tax? Average we can make later, but profit after tax calculation is very significant. Except the ARR, in all the other methods of capital budgeting, we use only cash flows. So please bear in mind, cash flow is differ from profit. Cash flow will be obtained after adding depreciation to profit after tax. I have already explained in the earlier videos how to calculate cash flows. Here also I will explain. And if you see the table here, profit before depreciation tax or earning before depreciation tax or cash flow before depreciation tax, either way you will be given in the question, and only same. From this we have to deduct the depreciation. Depreciation is a notional expenditure that should be deducted. It will not be incurred actually. We don't pay any money in the form of depreciation. It is a reserve we create to replace the asset. That is, you bear in mind. So we deduct depreciation. After that we get profit before tax. From that we deduct the tax element. Then we will get profit after tax. Like this we will be calculating profit after tax, which will be used for calculation of ARR. In case of accept and reject rule, if it is an independent project, if it is only one project, what is the procedure of accept and reject rule? More than targeted ARR. Suppose you have decided the percentage, let's say 12%. If you get more than 12, you should accept. If you get less than 12, you should reject. That is 12 is your cutoff percentage. You have determined, you have decided that whenever I invest money, I should get minimum this percentage. In case of mutually exclusive, in the sense both the project or 3 project, 4 project competing with each other is called as mutually exclusive project. Of these project, you have to select only one project. In that case, whichever projects gives you higher ARR, that should be accepted. This is a precise way of remembering accept and reject rule. This is the illustration 1. Project X requires an investment of 1 lakh and it earns a profit after tax 30,000 for a period of 10 years. Every year 30,000 the project is earning for a period of 10 years. Calculate average rate of return. Very simple. When you come to the answer, apply the formula, that is ARR is equals to average profit after tax divided by original investment into 100. So ARR is equals to average profit after tax, that directly is given in the question, that is 30,000. 30,000 divided by 1 lakh rupees is the investment into 100 is equals to, we are getting 30%. In the sense, averagely this project is earning 30% every year for a period of 10 years. So like this, very simply you can calculate. We'll take up one more illustration. The machine cost is 1 lakh and has a scrap value of 10,000. After 5 years, the net profit before depreciation and after tax for 5 years periods are to be projected that first year 20, second year 24, 30, 40 and 50,000. Like this, these are the projected profits before depreciation and tax. This is before depreciation, but what we require after depreciation and tax, bear in mind. Tax percentage given is 50%. Calculate payback period and accounting rate. Both we have to calculate, payback period and ARR. How to solve this problem we will see. What is the formula of ARR? ARR is equals to average profit after tax divided by original investment into 100. If you apply the formula, we don't know average profit after tax. That's the reason why I kept question mark over there. But investment we are aware, that is 1 lakh investment we made. into 100 is the common value is equals to, we don't know the answer since we don't know average profit. For this, we have to come to calculation of profit after tax and cash flow. Both I am calculating here in one table only, since we have to calculate payback period even here. Both we are asked to calculate. So how to calculate profit after tax and cash flow, that I am showing here. First we'll take a profit before depreciation and tax, that we have already given. First year 20, second year 24, third year 30, fourth year 40 and 50, so on we have given. Then we need to calculate depreciation. Depreciation we have not given in the question, therefore we have to calculate depreciation by using the formula. What is the formula? Cost of the asset minus scrap value divided by life. So depreciation is equals to, cost is 1 lakh rupees minus scrap value given in the question, that is 10,000, divided by life is 5 years, is equals to, you will get the answer is 18,000. Whenever you don't find any percentage, you will apply this formula and calculate the depreciation value. So depreciation value is 18,000 rupees. Then we have to deduct this depreciation every year, 18,000. Then we will get the profit before tax is how much? First year 2,000, second year 6,000, 12,000, 22,000 and 32,000. So on we will be getting profit before tax. This is. From this we have to deduct the depreciation value, that is 50%. 50% of profit before tax, that is 2,000 into 50%, 1,000, 6,000, 50%, 3,000, so on, 6,000, 11,000 and 16,000 we have calculated taxation. Once you deduct this tax, you will get profit after tax, that is 1,000, 2,000 minus 1,000, 6,000 minus 3,000, 3,000, 6,000, 11,000 and 16,000. This is profit after tax. So once we got profit after tax, what we have to do? We have to make a average profit. So average profit is equals to summation of the profit divided by number of years. That is 1,000, 3,000, 6,000, 11,000, 16,000. You make all the profits summation. Once you make summation and divided by number of observations are 5, then you will get average profit is equals to 7,400. So once you get average profit, apply the average profit as a numerator. 7,400 divided by 1 lakh into 100 is equals to 7.4%. What is the ARR of this question? The ARR of this question is 7.4%. So like this we have to calculate the ARR. Once ARR is done, we are even asked to calculate payback period. Already I made payback period problem video. I will share the link in the I button as well as in the description box. You can watch that specific video of calculation of ARR. I will show you how to calculate the ARR even. So if you see the calculation of ARR is equals to, what we have to do? We need to calculate cash flow. How to calculate cash flow? To this profit we have to add back depreciation, 18,000 again. Earlier we have deducted the depreciation to calculate profit after tax. To this we have to add back the depreciation, then we will get cash flow. First year cash flow is 19,000, 21,000, 24,000, 29,000 and 34,000. Once you add depreciation, you will get cash flow. The question arises, why should we add depreciation? Because depreciation is not non-cash expenditure that should be added to calculate the cash flow. So you calculate this cash flow, you can calculate payback period. For calculation of payback period, you should prepare the table. Why should we prepare the table? Because the cash flows are non-uniform. When this is non-uniform, you have to prepare the table to calculate. Year 1 cash inflow is 19, 21, 24, 29, 34, so on. But next column is cumulative cash flow. That is first year 19, then 19 plus 21, 40, 40 plus 24, 64, 64 plus 29, 93, 93 plus 34, 127. Like this we have calculated cumulative cash flows. Once you calculate cumulative cash flows, then it is quite clear that we have invested 1 lakh rupees. In which year we are getting back our 1 lakh rupees? In the year 4th and 5th we are getting our 1 lakh rupees. In the sense, our payback period lies between 4th year and 5th year. 4th year we are getting 93, 5th year we are getting 34,000. If you take 5th year also cumulative, that is 1,27,000. That is more than 1 lakh rupees. So it is obvious that our payback period lies between 4th year and 5th year. To calculate the exact payback period, you can apply the formula. The formula is payback period is equals to base year plus investment minus cumulative cash inflow of base year divided by cash inflow of the end year. So if you apply the formula, what is our base year? The year in which you got the 93,000 as a cumulative cash flow. So 4th year is our base year plus 1 lakh is our investment minus cumulative cash flow of the base year, that is 93,000, divided by cash inflow of the end year, that is 34,000. If you simplify this equation, you will get the answer is 4 plus 7,000 divided by 34,000. Therefore, 4.2 years is our payback. So in this way you can calculate the payback period as well as ARR. I hope I made you understand with the help of this difficult question how to calculate ARR as well as payback period even. So it is quite clear, I hope. Now we will understand merits and demerits of this. What are the merits of ARR? It is easy to calculate. It is based on accounting information. Calculation is easy. Information we use accounting information, that is profit after tax. It is not based on time value of money. We need not to calculate time value because time value is difficult task to calculate. It is considered total benefit associated with the project. In other methods we don't consider total benefits, but here we will consider total benefits. These are the merits of the what we call accounting rate of return. Now when you come to the demerits, it ignores time value of money. Time value of money not considering is also one of the demerits, because time value of money is a modern technique which should be considered. It ignores the investment potential of the project. Different methods are used for accounting profit, so it leads to some ambiguity, difficulty and confusion in calculation of projected profits. So these are the some of the demerits. Clear? I hope I made you understand the entire crux of the accounting rate of return. So I wish you all the best. Thanks for watching my video. Do subscribe my channel, Mentor the Trusted Guide, and motivate me to make more qualitative and informative videos. Thank you very much.